It's July 7th, 2026. This essay is on the bond market. The bond market is confirming, the same story that the leading economic indicators are telling us right now. And that is, the economy is facing some stiff headwinds, principally from inflationary pressures being placed on consumers. For example, as of today, the producer price index is up over 13% over the last 12 months. And those are brand new inflationary pressures coming downstream at us through the supply chain over the next 6 to 12 months. But more on that later. In regard to the bond market, if you're trying to address which way the economy is pointing by, looking just at the bond market, of the 8 data points I cover, 1 data point is pointing up, and 5 are pointing down, and 2 are just flat. Taking a closer look. This is a picture of the bond market at the 60,000-foot level. In the simplest of terms, red arrows are negative and green arrows are positive. And as I mentioned a moment ago, 5 bond market indicators are in the red and only 1 is green, which is to say the bond market is pointing towards a softer economy coming at us. Short term, interest rates are all down. The federal funds rate, 3-month T-bills, and 2-year treasuries are all down if you're looking through a 1 to 3-year window. Okay, what's that telling us? Let's back up a second and ask the question, who cares? The whole point to this exercise is to help price assets. Let's say you're looking to buy or sell a commercial property, or for that matter, a business. Do you argue for a higher price or a lower price? This could be real money, and knowing where the economy is at any given time might well make all the difference between success and failure. If you need help buying or selling commercial property, feel free to reach out to me via email or check out my website at temple360advisors.com. Let's start off by looking at the federal funds rate. The federal funds rate is the target interest rate set by the Federal Reserve that commercial banks charge one another to maintain their reserve requirements on overnight deposits. In other words, it's really the shortest of short-term loans. It's literally just overnight borrowing. At the moment, you can see it's been stepping down lower for the last 24 months. Today, it's at 3.63%. Now, having said that, here's the problem. Politicians and the legacy media, for some reason, focus on the federal funds rate, and for some unknown reason, argue that if the Federal Reserve drops the rate on overnight deposits, that this will in effect stimulate the economy. I guess in the simplest of terms, it might make some sense. Talking heads certainly make that claim, but it's simply not true. Let's look at history. This is the federal funds rate over the last 70 years. The gray bars indicate recessions. If you look between the gray bars, those are periods of expansion. And during these periods of expansion, between the gray bars, you can see that interest rates tend to rise, which is to say, they're positively correlated, i.e., given the economy expands, interest rates tend to go up. Given a recession, again, those are the gray bars I've circled in red, interest rates tend to go down, oftentimes in advance of recessions. The point being, a drop in the federal funds rate doesn't argue for an economic expansion, but for a contraction. Now, having said all that, let's look at the federal funds rate tracker. The rate tracker is a benchmark indicator of what the marketplace is expecting from the Federal Reserve in their next open market meeting, which is on July 29th. At the moment, forecasters are arguing a 25% probability of a rate hike. This is significant in that it might pretend that the Fed is concerned about inflation and wants to get in front of it by raising interest rates. But as I mentioned earlier, with the producer price index already up over 13% over the last 12 months, that's already baked into the cake. A new round of inflation is coming at us regardless. Next, I want to take a look at the yield curve. This is the yield curve. It's the 10-year Treasury minus the 2-year Treasury. In the simplest of terms, when the trend line is up and to the right, it reflects a positive yield curve. When it's not, and it's heading down, it's a negative yield curve. Let me try and explain the yield curve, with a simple pencil. Now, theoretically, and or what we might call normal, is when the yield curve is positive. It's upward sloping. That means that short-term interest rates are at the lower end and long-term interest rates are at the high end. This makes logical sense in that the longer you lend your money, the more risk you bear. And the more risk you bear, the more money you'll want to compensate you for that risk. That just makes sense. Now, here's the problem. Now, at times, the yield curve will invert. It goes like this, where the short-term interest rates are higher than the long-term interest rates. This is, in fact, an inverted yield curve. In the case of this graph, the slope goes negative. Well, what does that mean? It means that investors are afraid of the future. They're taking their money and going short-term rather than investing long-term. That pushes short-term interest rates up. And the point being, investors are simply trying to avoid long-term risk. Now, having said all that, if you look at the last 6 months, the yield curve is currently trending negative. Arguably, that takes us back to essentially the start of the war in Iran in February. And investors are pulling in their horns and going short-term to avoid risk. Also, as a point of reference, over the last 50 years, every time this has happened within a couple of years of experience an inverted yield curve, we've had a recession. And having just said that, arguably this time around, it may or may not happen. But if history has anything to say about it, it would be in effect giving us a warning. One last thing. Question. So far, we've just talked about the economy, but I know what a lot of people simply want to know is where interest rates are going. Well, with the war in Iran and the supply constraints with oil and gas, with fertilizers, with helium, et cetera, with the Strait of Hormuz, then if you couple that with the producer price index being as high as it is, more inflation is coming at us, almost as a given. The only thing that will corral that from happening is a demand destruction, i.e., in economic terms, it simply means that people quit consuming and prices are forced down because of declining demand. But short of that happening, and that would be essentially called a recession, don't expect interest rates to come down anytime soon. Hope that helps. If you're a real estate broker and looking to expand your business, check us out. We're eXp Commercial Real Estate. You can either email me or check out my website at temple360advisors.com.